Hey guys, I had the honor of speaking with Shang Chou, the head of client solutions at Kurv Investments. Shang had previously worked in the financial space at Goldman Sachs and JP Morgan Chase, and we had a great conversation about his new income ETF products, their potential for high monthly dividends, the risk involved, and so much more. And no, this is not a sponsored video. I did not get compensated by Kurv. I just figured it would be great content for the channel to have somebody in upper management come speak to us, and we might have him again on the channel, so let me know if you have any questions about the funds in the comments below. I apologize in advance if the sound isn't super clear. I put the mic next to my face when I probably should have put it next to the speakers, but oh well, captions are included, so be sure to be watching with those on. But without further ado, here's Shang. Shang, can you just kind of tell us about Kurv Investments and why we should spend our hard-earned money with these funds?
Absolutely, Cody. Yeah, so a little bit about Kurv. We're a relatively newcomer to the ETF issuer space, but our team is actually quite experienced. Both myself and our CEO and founder, Howard Chan, we both have roots stemming back to firms like Goldman Sachs and PIMCO. Howard actually was the individual who headed up and built PIMCO's European ETF franchise to north of $6.5 billion in assets. And not sure for folks who might be following the space, but a few years ago, there was a few SEC regulatory rule changes which permitted innovation and broadening of strategies that were easily implemented within ETFs. And so Kurv is really trying to focus on that and to really try to democratize and bring some of these previously hard to access institutional strategies into an ETF wrapper, which, as we all know, can be accessible to almost anyone.
Awesome. So what would you say is kind of the main strategy of your funds?
Yeah, absolutely. And as I said, we're a relatively new and young firm, and our initial debut suite of strategies was only just launched about 3 months ago at the end of October. So our inaugural suite is a set of 6 ETFs that focused on harvesting yield premia, and the way we do this is by selling covered calls. So we're selling a call option on top of an underlying long equity position. And so we do this in 6 different flavors, all of which are sort of large cap technology companies. And one of the main reasons we picked large cap technology companies is most of these, if not all of them, issue very little amounts of dividends. So there's 2 names that actually have dividends, but the remaining 4 actually don't pay dividends. So now investors can actually access sort of an income bearing strategy on top of this technology company exposure as well.
Okay, great. So how would you say, how far out of the money or in the money do you go with some of these call options?
Yeah, that's a great question. And so, this is part art and part science. As you know, when you are selling a call option, right, you're earning a premium. And so you have to be very careful to think strategically, where you want to sell the strike and how far out in terms of maturity. Maybe I'll take a step back and sort of talk through how our process is around this. And so first and foremost, we want to work with what the market gives us, right? We're never going to try to hit a distribution yield number just to make that number look really good optically. And by doing that, we're taking all sorts of unwarranted risks. So you look at what the market gives you, and sort of a call, covered call 101 is really, one way I like to think about it is like, let's say you held a stock and there was a certain amount of upside of which you're happy giving up after a while. So whether that's 10%, 20%, 30%, there's a certain ceiling where after that point, you're fine giving that up, and then you sell the call at that point and you harvest the premium, collect the income. So we try to think about this in a few different ways, right? One, you want to set the ceiling high enough where you have upside appreciation or capital appreciation of the underlying stock. 2, you also want to generate an attractive, amount of income, right, or yield from the strategy. 3, this is something we've seen, in other types of strategies where you definitely do not want to erode the NAV of the fund, right, the principal of the fund. You don't want to be paying distributions from there. You want to generate your distributions from the call option you're selling. So all those are sort of a fine balance that we try to manage. And obviously, as the market dynamics shift, right, as volatility rises and falls, this is going to give you different amounts of opportunity to generate yield. So all of these are actively managed on a day-to-day, ongoing basis. We have a whole institutional portfolio management process behind this, as well as risk management with ongoing monitoring of the positions. A really big part of how we're different here at Kurv.
Awesome, awesome. And so you mentioned that it's actively managed, not passively managed. So a lot of people always ask the question, hey, like why are some of these expense ratios a little bit higher than like a standard S&P 500 index? Which, but you'd say because it's actively managed, you guys are kind of on a daily basis looking at the best options, plays to do, and that kind of goes into that expense ratio.
Absolutely, and maybe I'll share a little bit more context there. And I draw from my personal experience. I spent about 4 years advising individual clients and families as well, so as an advisor. If one were to replicate this type of strategy, I'll just never forget. I had one client that liked to call at 6 in the morning to sell covered calls on stocks they held. And if you had one of those clients, sure, your morning's pretty busy and a little bit shot. But if you had 3, 5, 10 clients all doing that, placing these trades, it would be an incredible amount of work operationally because you're setting these trades, you're targeting the strikes, you're trading the options. Concurrently, from a cost perspective, so if you and I went and sold these options, typical bid-ask spread on options is maybe 10 to 25 basis points. Because we have an institutional execution capability, we're able to trade these at 1 to 3 basis points, so a fraction of the cost. Concurrently, to replicate the set of trades that we're doing in our covered call suite, it's about 200 trades on average over an annual basis. And for us, it's just a set it and forget it ETF line item. So from an operational perspective, there's a lot of efficiencies. The other component I touch on, and I think is very important for most investors, is taxes. While we are not tax advisors, and I would never give tax advice broadly, very generally, if one were to implement a covered call strategy, say in a separately managed account or a brokerage account, typically you sell the call, you harvest premium, those get taxed at short-term capital gains or income rates. Conversely, when you do that within an ETF wrapper, there's some synergies there. One potential example is if you sell a call option in an ETF wrapper and you replicate the underlying long stock position with a long call and a short put, there is certainly the potential to leverage an IRS rule, the straddle rule, in which case the income distributed out of the ETF actually comes in the form of a return of capital. Return of capital is not immediately taxable. What it actually does, it actually chips away at the net asset value of the fund. But the punchline here is you've all of a sudden converted a short-term capital gain into a long-term capital gain, which is obviously at a lower tax rate.
Right. So, that's what I always tell people too when they kind of complain about some of these high expense ratios is that, if you were to do options trading on your own, like with a company like Microsoft, right, that'd be tens of thousands of dollars. Not everybody just has that. And that's one of the reasons why I have exposure to income ETFs in my portfolio is that I also know it's super time consuming, right? It's you need the capital, you need the time, and then also just having your guys' expertise in doing it as well. That's why I think sometimes, hey, it might be a little bit more expensive, but it's worth it. And then you talked about some of the tax consequences. So of the distributions so far, let's say maybe, for the one that you guys have on Microsoft, how much of it so far has been return of capital?
The vast majority, I'll say, and we'll have to wait till the end of the fiscal year. But rule of thumb, ballpark kind of number. Expectation is the majority of it will be in form of return of capital. Of note, and I should mention this as well. Within our covered call replication, as I mentioned, we're selling the call option. We're replicating the long synthetically with a long call and a short put. But one of the beauties of options is that, let's say you replicated that long stock position with a long call short put, you actually don't need to put 100% of the capital down to get the exposure. Hypothetically, maybe put $10 down on $100. You still have $90 of cash to actively manage. Given what we know today, the front end of the yield curve is inverted. We can actually deploy that cash into things like US T-bills, which are yielding something roughly around 5%, which definitely outperforms cash. So if you actually look at our holdings on a day-to-day basis, you'll see those three portions. You'll see the short call, the synthetic long underlying, as well as US T-bills, which are actually generating interest income as well.
Right. So there's actually multiple ways to kind of make a profit here, right? So you own the treasury bills, there's obviously the options plays, and then some capital appreciation.
Exactly.
Okay. And then you said you were kind of synthetically owning some of these positions, and that kind of allows you to kind of leverage a little bit more money and potentially get some more, premiums out of that.
That's exactly right. Yeah.
Okay. So we have a question here from one of my subscribers. His name is Ryan. He wanted me to ask you if you plan on doing any leverage dividend products or sector ETFs such as cybersecurity or semiconductors. Is that on the horizon?
That's a great question. I'm limited in certain what I can say as far as product pipeline, but I will say we've heard the feedback and it's always greatly appreciated. Anytime folks see something that's out there that they would enjoy using or find useful, please do reach out to us. info@kurvinvest.com anytime. We're all ears. We have heard that sentiment from Ryan and from other folks as well, and we have stuff in the pipeline. So I say stay tuned. Just watch the space.
Okay, great. Yeah, we'll definitely keep an eye out for that. And my channel, we're constantly talking about income ETF. So a lot of people, they want to know what is the difference between your investment company and the different ones out there like JEPI or Global X or Yield Max products. What sets you guys apart?
Yeah, I think all those are terrific firms, and they all do a really great job of building good products. I would say starting specifically with just the covered call suite, where we really try to differentiate ourselves is taking that institutional approach to managing the portfolio. So the three tenets I sort of mentioned were, we try to maintain an attractive upside appreciation, capital appreciation potential, set that ceiling with enough headroom to kind of grow. We also try to generate attractive levels of income, given what the market's giving us, looking at what implied volatility is, kind of movements of the underlying stock. And then concurrently, I think the third thing is the most important, is that we really, really try to focus on minimizing the risk of NAV erosion. There was a really great piece in the Wall Street Journal a few weeks ago, which covered actually Kurv as well as other covered call strategies. And, the headline of the article is something like, you see a ETF offering 90+% yield, right? Like, what's going on? And really that's to my point originally, which is, we really try not to manage to a distribution yield target. We try to figure out what the market is offering you. We balance those three different things from an institutional approach, and then try to generate a really attractive total return kind of component to the ETF strategy.
The next question here we have is, how would it perform in a bullish market, this ETF, your ETFs?
Yeah, I would say, maybe bifurcate the bull market, component where, I think covered call strategies in general, they will lag, they will underperform if the stock just goes parabolic and just shoots up. In those cases, you've sold your upside in return for the call option premium, and you've sort of capped yourself. So you're probably going to miss out on that additional upside. That said, if the stock kind of slowly grinds up over the course of, a year or, half a year, multiple months, there's a good chance that you may be able to keep up. And part of the reason of that is that, we are rolling those options positions on a monthly basis. So let's say the stock never really hits that ceiling. You'll continue to ride the upside potential while resetting that call option ceiling periodically. So on a slow grind upwards, it should be able to track the underlying as well as generate that option premium. But certainly in those situations where the stocks just shoot up on, say, surprise earnings or whatever it may be, you'll definitely lag the underlying.
Right. So those markets where, let's say Microsoft is slowly going up and up, month after month, those would be the optimal times for these particular products because they're capturing some of that upside and then they're also getting the, the dividends as well as the premiums.
That's exactly right, yeah.
Okay, and then on the flip side, how will these funds kind of behave in a bear market?
Yeah, that's a great question. In a bear market, these types of strategies will actually outperform, but I think it's really important to emphasize you're still riding the downwards trend of the underlying stock one for one. The reason you'll outperform is you've sold the call, which is now expiring out of the money. So you're going to always earn that option premium. But that said, you still have the full-on underlying long exposure. In our situation where we're replicating it and we have the T-bills, you'll still earn on the T-bills and slightly outperform. But that said, the risk, for the position itself is not going to be too dissimilar to just being outright long.
Okay, so yeah, just having maybe some exposure to these in a bear market. A lot of people think that market might be slightly overvalued right now. This could actually be a way to maybe get some outperformance.
Yeah, and not to get too in the industry jargon, but
yeah.
When you look at it on a Sharpe ratio basis, simply just meaning the return versus the volatility. These types of covered call strategies tend to have higher Sharpe ratios, meaning they just, on a risk-adjusted basis, they have a higher degree of return. And so this is just based on recent performance of these types of strategies. But so if you're thinking about it from a portfolio implementation context, you would be introducing, say, a higher Sharpe or even a lower beta exposure, so to the portfolio overall. Yeah.
So, Shang, who would you personally say these funds are specifically designed for? So, for example, I'm in my kind of late 20s, so I'm still kind of going after growth. But, I have a lot of viewers who are kind of close to that retirement age, and then people kind of all spread out there. So is there kind of a specific demographic that these funds might be a little bit more optimal for?
Yeah, no, and I really appreciate that question. And, maybe I'll kind of zoom out a little bit, but I really did want to just emphasize, that Kurv here, we're incredibly passionate about education and client service. And I think for folks who can understand this type of strategy, which is, admittedly a little bit more complex than just owning a stock outright, it could be appropriate. To your point, folks who say may need income or want to generate yield premium in this manner, this could be a really great strategy. Some of the ways we've heard anecdotally that this has been implemented are as well as tax-exempt accounts. And so we've had folks who are, say, retirees have a large single stock position in an IRA, or other cases we've heard in a charitable account. And they're saying, well, I have a ton of exposure to this company, but I'd like to diversify those sources. But that said, I still like the exposure. So swapping some, of that stock out for one of these covered call strategies could make sense. Other instances are folks who want to build an income portfolio like yourself, right? Who say, I would like to introduce alternative sources of income. Again, getting you more into the industry jargon, but what a covered call strategy is you're adding a short volatility exposure as well to the portfolio via that call option selling. And that's a type of exposure that I think a lot of investors who are looking for income don't have. And typically people will hold things like treasuries or credit or other types of fixed income instruments. The short volatility type of yield premia is sort of a diversified, differentiated source of potential income for a portfolio. So it could definitely be implemented that way as well.
Okay, and when I personally own a couple income ETFs, so the biggest thing that I actually look for is not necessarily how high the yield is, but how well they're protecting that NAV. And I was, glad to hear that you touched on that earlier, that one of the big principles for you guys is preventing against NAV erosion. We've definitely seen that with some of these other income ETFs. So can you kind of talk a little bit about what your strategy is in, kind of trying your best to prevent that, but then at the same time also, I know it's an income ETF, so you're also trying to give out those juicy distributions as well.
Absolutely. Our founder and CEO Howard has a great analogy that I love to borrow. It's as if you had a rental home, right, that you're generating rental income from, and arbitrarily you just decided you wanted to hit a certain rent number or rent yield percentage. And for whatever reason, the rent you're generating was not meeting that arbitrary target. So you just decide to selling parts of your house, right? I'll sell the garage, I'll sell the kitchen. One, it doesn't make a lot of sense, right? You're kind of, mismanaging the strategy. Two, it's incredibly tax inefficient, right?
Yeah.
And so if you think about eroding NAV, you're taking from your principal, you're running it through this, at least from what we see in some of our, competitor strategies, really inefficient sort of tax treatment. Just to create a distribution yield that looks optically very good. So we're not fans of that, and we would never do that in terms of our strategies. That said, I think there is a component where you want to be very thoughtful of where you sell that call option. And just to kind of give you guys a little bit more behind the scenes peek into that, we're looking at a lot of different components, and this is an institutional process where our portfolio management team is evaluating where the most attractive place to place the strike is, where the most attractive place to place the expiration date is of the option. Currently, right now, from a maturity perspective, roughly 1 to 2 months out is a pretty good place where you can harvest attractive amounts of yield premium. You have to look at things like the volatility surface. And these are just things that the market gives you, and they change on a daily basis. So month to month, you'll see variations in that yield that we're distributing. But overall, would definitely want to emphasize the fact that this is all run through a very institutional portfolio management process.
Yeah, and while doing some research for this, I saw your Amazon fund is actually doing really well here. It's up 17% in the since it's been out.
Yep.
And then, just to clarify, all these different tickers, they're all kind of practicing the same strategy. The only thing that's kind of changing is the underlying security.
That's exactly correct, yes.
Okay. And are you guys, some income ETFs are kind of actually managed by a third party? Do you guys manage the ETF yourselves, or is it a similar situation?
Exactly. We have a great firm that we sub-advise for, and they actually run these types of strategies across billions of assets, and so we work with them very closely. We also do have our own internal portfolio management specialist and team, where we concurrently look at the strategy as well with them in conjunction. And so it's very much a team-oriented approach, where you sort of have a belt and suspenders, perspective, and you can really look at what are the exposures in real time, the risk management, the ongoing monitoring. So that's a big part of what we do here at Kurv.
Okay. And would you say there's any chance of maybe like a wrapper ETF consisting of all the ETFs that you guys manage? And I know there's only a limited amount that you could say, but
yeah, no, we love that question. And again, I'll say, stay tuned, watch this space. We're working on some really interesting things, and definitely in that wheelhouse as well. Yeah.
Okay, sounds good. And Shang, we have one last fun question, but before I ask that, is there anything else you want to highlight about Kurv or any of the investments that we haven't already maybe touched upon?
Yeah, maybe I'll say two things, and I think the first is sort of a ETF 101, kind of fun, tidbit. We get this question a lot, and people will say things like, the ETF doesn't seem like it has a lot of liquidity or trading volume. And this goes across all ETFs. And so I think a really important component of education is, ETF has both the secondary liquidity and primary liquidity. And what that means is secondary liquidity is the amount of volume that you're seeing traded. Primary liquidity is the volume of the underlying components. And so when you're considering trading an ETF, you want to focus on the primary, so what the underlying components are. In Kurv's case, these are very robust liquid options that are traded, quite frequently, as well as T-bills. So no issues there. And then the second thing is that, this is sort of a best practice. I always do this myself in my personal account when I'm trading an ETF. One, I try to avoid trading early in the morning or late in the day when liquidity is limited.
Yep.
And even if you are trading in the middle of the day when there's robust trading volume, best practice really is still just to use a limit order. I don't want to just throw a market order out there and let the price kind of deviate, from where I'm expecting. But putting a limit in there is sort of a great way to do it. And you can look at the bid-ask spread, pick a midpoint, and kind of set that as a limit. Yes, there is a risk you won't get your order filled, but that kind of eliminates any kind of, we've seen some trades kind of go a little bit sideways on that. So just sort of a best practice. And then the last thing is, obviously, we're incredibly passionate here at Kurv just to help educate investors. So if there's ever comments, questions, feedback, don't hesitate to reach out to us. info@kurvinvest.com. We're always here to help.
Okay, awesome. Yeah, I know personally I always had that liquidity question myself, and it's a common question I see in the comments as well. So just one last, fun question here. I'm part of several different Discords. There's lots of YouTubers that make, income ETF review videos. I will say there's a certain niche of people, and this question comes from another subscriber named Brian as well. He wants to know, is there really such a thing as free money? Now, I know an educated individual like you, that's a ridiculous question, but I do see a lot of people in these Discords on Reddit. They kind of talk about these income ETFs as if they're free money, but obviously I think we both know there's no such thing in the world as free money, right? There's always some sort of risk, correct?
Thank you for asking that, Cody. I think that's such an important question to ask and to highlight. In finance, they always say the only free lunch is diversification, right? And so, to your point, there really is never a free lunch. Another way I've heard it kind of framed is, you can never eliminate risk, you can only transform it. And so I think it's really important to understand for investors using covered call strategies and other types of income harvesting type strategies, what you're really doing is transforming risk, right? To my point earlier, for a covered call, what you're saying is there's a certain upside which I'm willing to forego, and for that, I'd like to collect an option premium. This is not too dissimilar from the insurance industry, right? As
right.
insurance companies are out there selling policies and they collect a premium. most of the time they get to pocket the premium, and which is why the insurance industry is so large and attractive. But that said, things like hurricanes and fires and floods, they do occur, and when those things do occur, the insurance company has to pay out. So really, really important when using these types of strategies to understand the types of risks you're taking on, and importantly that really there's to Ryan's question, there's not a free lunch. You're earning something for providing something,
exactly.
and that's really the trade-off here.
Yes, thank you so much for clarifying that, because that's a comment I get all the time. I see it all the time on Reddit, Discord. You gave out your contact information. I'll continue to make videos about this.
Yeah, absolutely, Cody. Any way we can be of help, please don't hesitate to reach out. So grateful for the opportunity today to just share a little bit about what we're building at Kurv. And as I said earlier, we're big fans of the channel. Keep doing the great work you're doing, and any way we can help, just reach out.
Okay, sounds good. Thank you so much for your time, Shang.
Absolutely. Thank you, Cody.
Dissector, you are an idiot.